So today's topic on our discussion radar is the impact of the elections, NDA 2.0 on the markets and the economy. Uh, we already know the results of the elections in India, and it was a strong mandate for the ruling party. And the markets so far, at least on the equity side and the bond side, have taken it well. So bond prices have gone up, and equity markets have done reasonably well. So it seems that the initial round of impact has been positive. Our idea here is to basically discuss a couple of things. We are going to discuss the impact on economics, which is what's the macro environment, and then what do we expect to happen, and then specific markets like equities and currencies and interest rates, and then what are we expecting in those areas as we go along. So that's in a nutshell what we are going to cover. So let's understand the event first. Obviously, there was a thumping majority that the ruling party NDA had, and this was stronger than the previous government, which is also rare in the context of Indian political scenario. That the same party basically comes back with a bigger majority in subsequent elections. Usually, it's not so clear a majority when parties return to power, but this time around there was a strong majority, and so obviously there was a huge uncertainty that existed around this because of the events prior to the elections, especially the economic events around demonetization and GST implementation, which had kind of put a cloud around what's going to happen. So that uncertainty is out of the way, and looks for a stronger policy push as we go along in the subsequent weeks and months and quarters as we go along. Right now, there are potential possibilities that are going to come out of this, and we're going to discuss all of them as we go along. Uh, what's uh, what's going to be interesting is to note the continuation of the policies that have gone on, and what's India going to do in terms of the macro environment that we have at this point of time, and what are we basically going to look at when we look at the next few years. So it's important to understand what's our macro environment right now, and how are we kind of going ahead in terms of looking at that. There are some evidences of a slowdown, right? Some sectoral slowdown is kind of evident, as evident by things around auto sales, for example. That's declined. The quarterly results of some of the companies, even on the consumer side, has not been very good. So that's something that we'll have to kind of look at and understand as to how this is playing out. But this is odd in the backdrop of an election year, because usually in an election year there is a consumption push, because an election itself is like a fiscal event in India, and so consequently a sectoral slowdown has more to itself than what we can just read on the headline. It's probably much deeper in terms of the problem that we are seeing, and we need to understand and address that as we go along. Having said that, as we said, it's likely that the government has a strong mandate, so tougher reforms, especially around land, infra, etc., would likely get addressed first. Before we go ahead, let's look at what the current fiscal scenario and policy for India is at this point of time. So what you see on the screen is the estimate of the 2020 interim budget that the government of India had presented in February this year. Now, this is obviously a slightly historical number, and we'll have a full budget coming again sometime in the coming few weeks, and we'll see what the actual numbers there are. But broadly, in terms of our, if we just do a quick recap of our entire finances, the total expenditure that's on the lower half of the screen is expected to be about 27.8 lakh crore. Right? Out of this total expenditure, there is a component called revenue expenditure, and there is a component called capital expenditure. Now, you could understand it as this way, that whatever adds an asset for the government is capital expenditure, everything else is revenue expenditure. So if you're building a bridge or adding some sort of infrastructure, that is a capital expenditure, but everything else is revenue expenditure otherwise, right? Now, revenue expenditure is increasing by 14%, and revenue expenditure is also nearly greater than 85% of the total expenditure for India. Capital expenditure is actually a smaller part of the overall expenditure. You would ideally want capital expenditure to be more, but at least in the interim budget, this number was lower than what was expected. And the announcement was also one of the lowest as a percentage of GDP, right? Total GDP that you see here is about 2 crore. And so basically that's what we are playing with, right? Now, when you look at this data on the earnings side, obviously your receipts have to be equal to the expenditure in order for them to match. And your receipts basically fall short by the expenditure by a figure of nearly 7 lakh crore, right? By a figure of nearly 7 lakh crore. Now, the 7 lakh crore is basically your deficit, correct? So the income of the government minus the expenditure, if this is a negative number, that's generally a deficit, right? So that's the fiscal deficit number we talk about. What are the other income sources for the government? So tax revenue is the biggest source. Government expects 25 lakh crore of tax revenue, and that's an increase of 14% over last year, which itself, I think this final number fell short of the total tax collection. So effectively, that's a steep increase expected, right? Especially in a scenario where the markets are, the consumer demand seems to be slowing down. So that's something that we'll have to see how that comes up. Now, out of this 25 lakh crore, nearly about 1/3 goes to the states, right? So when 1/3 goes to the states, then that part basically is taken out, and the remaining part, which is about 17 lakh crore, goes to the center. So 17 lakh crore is the tax revenue net to the center. Then we are looking at about 2.5 lakh crore or so non-tax revenue. Your dividends and the RBI income, RBI dividend, etc., all that come here, right? You have some other recovery of loans, etc. This 90,000 crore is your disinvestment target, which the government has actually started up pretty quickly as soon as they kind of got elected. So that's the disinvestment target. You add all of this, the difference between the spending and the income, which is 1977, about nearly 20 lakh crore, is this fiscal deficit number, which has to be borrowed. There is no other way around this. If the government is going to see a funding mismatch, there is going to be a borrowing that is going to come on the anvil, and that's basically what we are looking at in the context of this scenario, right? So fiscal deficit, which is this 7 lakh crore number, as a percentage of our GDP is 3.4%. So fiscal deficit as a percentage of GDP is expected to be 3.4%. That's the expectation in the initial budget estimates that we have seen, right? That's the first part of our puzzle that we have seen. We'll come back to this and discuss this a little bit more as we go along. Next, we move on to the situation around balance of payments. So this is basically imports and exports of India. And what is the scenario that happens in terms of the trade deficit of India. Now, when you look at imports and exports of India, this is, remember, goods, imports and exports. This does not include services, correct? So this is only merchandise, goods, imports and exports. Services is a net export from India, but goods is a net import for India. So if you look at this number, and let's just focus on the last 3 years once, you see exports have grown steadily over the last couple of years from $275 billion all the way up to $329 billion. But so have imports. And in fact, imports have grown at a faster clip to go up. And this 10% is only the last year. The year before that was nearly 20% kind of a jump. The jump in imports has been led partly because of rising oil prices. So as oil prices go up, the oil import bill of India goes up, and this is in US dollar billions. So that's $87 billion going up to $141 billion. And the non-oil imports, which primarily the top two that you will see here is gold and silver. And the second one that you will see here is electronics, consumer durables, basically electronic items. Those two have kicked up. Oil, gold and silver have actually not gone up too much, but it's electronics jump that has created a little bit of a challenge for India's balance of payment scenario. So the amount of dollar coming in versus the amount of dollar going out, there is a mismatch. Now, about 7 years back, we used to export $300 billion and import about 490, and our trade balance was about $183 billion. This is, remember, again, only goods. I'll come to services in a minute. And even now, we kind of export slightly higher, we import slightly higher. So the net balance is still 184. So we haven't really done anything of this over the last, 7 years. And that's despite a fair bit of noise that has been made in terms of make in India and what we are trying to do with a manufacturing base. Just tells us how difficult it is. It's not that we don't want to do it. It's just that when we want to increase exports, someone else has to import it. So we can't unilaterally go ahead and say, I want to increase exports, so exports will increase. Someone has to import that, and that'll only happen with a global demand that comes up, right? So that's part one of the problem. Part two of the problem is, if you see oil prices were high for the first 3 years here. Then they fell. And when they fell, it went from 160 to 80. So there's a big saving of $80 billion, but that's gone back to about 150 now, right? So the entire saving on account of oil is kind of off, and that kind of is a challenge. So our trouble right now is rising oil. Now, the other thing you need to note is that this 183, if it stays 183, we would have some Forex reserves, right? And so Forex reserve should go down pretty quickly if this is minus 183 every time. Now, Forex reserves around 2012 were $250 billion, but now are approximately close to $400 billion. So reserves have gone up, which means something has come in. What is that something? There are broadly three line items that come in. The first one is services exports. So services net export number is about $70 billion. The second is what is called as remittances. So NRI remittances that come in. India gets one of the largest amount of NRI remittances. So that's about 60 to 70 billion dollars on average. And the third is foreign institutional investors and foreign direct investment portfolio and investment flows, which is another 60 to 70 billion dollars each year. These are all in billion dollars, right? If you add these three, they add up to something like 180 to 200. And so that keeps happening every year. And because of that, this stays in balance, correct? Now the challenges that are going to come up. One, there is a general slowdown that is there that is affecting some part of the industry. Two, something that is a benefit for us, which is rising per capita GDP, right? So that gives us a rising disposable income as well. And the disposable income basically rises at a faster clip than per capita GDP, because if your income is, let's say, 100, then out of 100, maybe nearly 90 is sort of non-discretionary items, food, rent, etc. But when your income increases in the next 5 years to, let's say, 200, then this 90 does not become 180, right? 90 probably at best goes to 120. So your disposable income goes up 8 times. If your disposable income goes up 8 times, you are going to try and buy anything that you don't have at this point of time. And a lot of that is not produced in India at this point of time. So it's likely that your non-oil imports are going to spike up unless we produce something in the country. Right, so that's one part of the challenge that is going to come up. You can't stop people from buying televisions and refrigerators, etc. So either we produce them or we get ready for some part of outflow that's going to happen on account of that. Now, to counter that, you obviously have to kind of create some inflows, but you have to identify what are your basic export segments that are going to come out. So we'll come to that, but prima facie, if there are a few export segments in India like textile, gems and jewelry, etc., and you're likely to see a good policy making on those fronts, right? So we'll come to all of this as well, but that's the net backdrop that in terms of our fiscal deficit scenario, which we saw earlier, we are slightly on the edge in terms of increased spending and not really spending in the correct direction. And in terms of our current account or trade deficit kind of numbers also, this has widened over the last year because oil prices have risen and non-oil imports have also gone up. We have not really grown exports at the same pace, right? This comes in the backdrop of growing global protectionism as well, where all countries globally are going inwards. They're trying to increase trade barriers, right? So even if we try to kind of export something, we will encounter those headwinds as we go ahead, right? So now what do we have? We have a US dollar 2.5 trillion, slightly more than this kind of a GDP. We expect the real GDP growth to be about 6 to 8% over the next 5 years. That's an expectation. There seems to be a slowdown, but given that we are a consumption driven economy, we should see this and the government should try to protect it. Inflation is expected to be 4 to 5% with probably a downward bias. When I say downward bias, it would mean that probably inflation is going to be benign. As countries mature, the volatility in inflation goes down. So price rises become less and less sudden, and consequently, overall inflation generally remains subdued. Fiscal deficit currently is about 3.5% of the GDP. Globally, people don't like these numbers, 3.54% of the GDP. So technically, there is limited headroom to increase it, right? But I'm not sure that we'll follow that path, so we'll go to that as we go along. Trade deficit, which is goods plus services, is about 2% of GDP. That has actually gone up a little bit. So current account deficit now, which includes trade deficit, is 2.5% of GDP. Tax as a percentage of GDP, if I go back a couple of slides, you will see this is the total gross tax revenue, 25 lakh crore out of nearly 2 crore. So that number of tax to GDP is approximately about 12%. That's what is the current number that we are expecting, right? Now, what is potentially going to happen in the next few years depends on a few things. So the current scenario, GDP is slightly lagging behind the 7% mark, current around 6.5, 6.7. There is a generic belief in India that GDP growth will be about 7 to 8%. Remember, when you are $2 trillion, then you are basically able to grow at, so 10% at $2 trillion is $20 billion. Sorry, $200 billion, right? But 10% when the economy rises to $3 trillion is going to be $300 billion. How are we going to get this extra 100 billion out of the blue? That's not so easily available. So we will need to kind of work around something there and see what's happening. Farmer distress is a reality, and this year again we are seeing that possibility of a lower than an average rainfall is clear. So there is a possibility of increasing the farmer income to push consumption in any case. Current account deficit approximately 2.5% of GDP. This number actually went down to close to 1% kind of a number earlier, but has come back again. Fiscal deficit is already crossing the target and it's expected to be higher. Make no mistake about that. It's not going to be 3.3, 3.4 unless the government does some drastic measure somewhere. Steps that we would expect the government to kind of take immediately is strengthen the bankruptcy code. Even now in the bankruptcy code, while there has been a lot of headway that has been made, uh, it kind of keeps revolving around in terms of time. That creates a problem for both the lending companies as well as the company that is under trouble, and that doesn't really allow proper resolution. So hopefully more work is going to happen there, and that will make equity markets stronger. We'll have to see what happens to the debt markets because of that. NBFCs, non-banking financial companies in India, are facing a liquidity crisis. That's because they went left, right, and center and gave out money to anyone who wanted money. And so obviously there is going to be an NPA issue that is going to balloon there, as well as they were over aggressive in terms of what they were trying to do in terms of trying to capture market share. A lot of them gave money to the real estate sector, and that hasn't seen any kind of a turnaround. So to control that, the RBI has introduced something called as a liquidity coverage ratio, which means that some portion of your assets that you are giving out has to be in liquid assets, and they can be immediately converted to cash and returned in case people need that. So that liquidity coverage ratio is targeted to be 100% by 2024. So that has to come in due course of time, which will reform the NBFC space, but not without some intervening pain to some of the NBFCs that encounter. Employment is a big issue. India's 60% of the population is in the working age group, right? And it's expected to remain there till 2050. there is going to be 60% of our population at all points of time till 2050 who are in the working age segment. Around 2050, our total population would be nearly about 150 crore. So we are talking about 90 crore people who are in the age group of 15 to 60. That's a huge number of people who need to be given jobs. Current unemployment rates are around 7 to 8%. That's rough estimates. No one really knows the extent of it. So that's something that the government will have to tackle, and we'll come back to this as well. And then fiscal prudence is what the government will have to kind of tackle on in terms of fiscal deficit. Right? We'll again see what they are going to do and what probably they are expected to do, and what they'll be pushed to do in this scenario. Longer term reforms is farm income doubling that they have kind of stated, and so there is going to be a continuous effort in, so this should be 2022, there is going to be a continuous effort on this entire scenario. Cash transfer has been announced, but it's likely to not suffice unless we make some structural changes. Remember, farm income in India now is a problem of oversupply. The production is more, and there is extensive reliance on rains. So both of those areas in terms of logistics have to be worked out, and in terms of irrigation systems have to be worked out. Ease of business, while the government keeps making a lot of noise around it, honestly not too easy to still start and continue doing a business in India. If you have to attract the FII and be in the top 30 to 50 countries, then this needs to become far simpler. Even simple things like uh, taxes, or the number of taxes that are being filed, have to kind of get reduced, and it has to be made cleaner and faster in order to achieve that. I think technology is going to be a big aid in this as we go along, and we're in the right direction. It's just the speed of execution that matters. That obviously creates a trouble for some of the FIIs, and that money moving in, moving out could be a challenge in any case, right? Uh, Big manufacturing push is expected over the next 5 years. Tax to GDP ratio is probably going to improve. We are currently at about 12%, and if this number goes up, let's say over the next 5 years, we would expect our GDP to go from 2.5 trillion to probably about 4 trillion. Today we make about approximately 12% of this as taxes, right? So 12% of this would be about what, $300 billion. That's our total tax collection at this point of time, gross. If this number increases and this 12% probably goes to something like, argument's sake, let's say 13 to 14%. Let's say I'm just taking hypothetical numbers, then 14% of 4 trillion could be in the range of $560 billion. That could be a substantial jump in the tax collection that government does over a 5-year period. Now, 12 to 14 is a pipe dream in my opinion. It probably will be around 12.5 to 13%, but we are still looking at about a $500 billion kind of a taxation collection if things go fine. That could be a substantial benefit in terms of widening the tax net and reducing the taxation rates for the both individuals and corporates. That could be a big boost. I think there needs to be a complete overhaul of the structure around startup policy, and the government probably, rather than putting tax on investment, should start looking at giving rebates on this, because these are the guys who are going to generate jobs for you. So that's something that the government has to take care. Also, in its idea to try and increase the tax net, the government has to ensure that they take care of the unorganized sector, because that is the biggest employment generator in India. And I think the last time that happened, demonetization basically hammered that down in between a little bit. That's a problem. Infra and airports, I think a lot of work has already happened, and that's continuing, and is continuing at a reasonably fast clip as compared to history of India. So that's likely to continue, and obviously there is going to be a big push that's going to come here as well. The government is going to find money, because a lot of the people who are joining the workforce are going to come in and give us this tax revenue. So this tax revenue, which is $300 billion today, could go up to $500 billion. That excess $200 billion is going to be extremely useful every year in terms of going ahead and allowing a lot of investment in some of these areas. Now that the government is strong, the mandate is strong, you would expect that a lot of these decision making would be faster, and consequently on the investment front you should see a lot of effort happening, right? A couple of other quick pointers. This is what we see about our Forex reserves, foreign exchange reserves of India. So there was a time when we were around two. So this is in millions. So we can convert it. We were about $290 billion here, and then we reached all the way up to somewhere around 420 billion here. Came down a bit to below 400. Still at $420 billion at this point of time. Right now, if I go back to that slide and try and compare when we were 183, correct? When we were 183. Let's look at our imports versus our Forex scenario. So imports were 483 and our Forex was about 260, 270, right? So that's a problem because technically if you leave everything else, then in a few months you will run out of foreign exchange reserves. Right now it's at about 420, so you are still kind of not really great in terms of position, but far better than what we were earlier. Right. So earlier we had about 6 months of import cover. Now we are talking about 9 to 10 months of import cover. So this has clearly improved, and that's a big advantage that we have at this point of time when we look at the forex reserve. This looks okay. Right. Plus, don't think this is going to be too big a trouble unless there is an emerging market crisis where FIs start pulling out. Unlikely that you would find too many markets worldwide with this kind of a demographic profile, this kind of a consumption pattern growing at 6 to 7% real terms every year. So the longer term challenge of FIs pulling out is also probably much lesser. So to that extent, I think as long as we can deal with our export versus import scenario, we are likely to probably see stability on this front. This shouldn't be too much of a challenge. What we see here is India's 10-year government bond yield, which kind of gives an indication of what is the interest rate in the economy. So, or expectation of interest rate in the economy. When the currency was falling in 2012-13, there was a jump in interest rates to try and control the currency fall. Post which, once the growth kind of came back, there was a consistent period where interest rates went down in a bid to try and basically control the entire increase the growth rate, kickstart the economy. Honestly, this rate cut cycle was fine, but the economy never got kickstarted around this period. What happened then was the currency again started deteriorating. So there was a period where rates were hiked again. But past few quarters and months, once again, these rates have started going down, right? Now, think about what should be interest rates in India. Interest rates would typically be something like inflation plus some return. Now, this some return is generally constant, and generally RBI says 1 to 2% is good enough. If your inflation stabilizes at about 4%, then interest rates in India need to go down to 5 to 6%. They're around 7% right now. So we are likely to see a reduction in the interest rate over the next 5 years. Right? When I say 5 years, that's a longer term prediction of interest rate cycle in India. Rates are expected to go down in India because we are maturing as an economy, and the government would want to basically, RBI and the government would want to kickstart the economy by keeping lower rates. This has a set of repercussions. We'll come to that separately, but it is likely that post this mandate that the government got, you again saw a dip in these yields and an expectation that rates will be cut faster because now the government would want to kickstart the growth in the economy, and for that they might become a bit aggressive in cutting these rates, right? So now let's come to what our expectations would be. Let's look at the prima facie possibility of what the government would do. They would want to focus on higher growth and they would want to focus on employment generation, right? Now, this can only happen if they spend more and they continue to have lower interest rates so that corporates also spend more and do capex, right? So you have to revive a capex cycle and you have to keep doing spending so that the consumption cycle also continues. If you keep spending, it is likely to be negative for the fiscal deficit, which means your spending will not be under control, right? And if you cut rates, that's likely to be positive for the investments in the economy. That's likely to be good. However, there is a sort of an interplay of these. If you keep spending more, then the government will have to borrow more. If you borrow more, then you have to pay more. So as you keep increasing the fiscal deficit, it might be okay for the time being, but it would put a floor on the interest rate. So, on one side, interest rates are going down, but if your government keeps becoming the biggest borrower, they will keep supplying bonds and bonds and bonds. So the rates will not necessarily go down to the levels that you want it to be. So in the short run, expect higher fiscal deficit. It's likely that the government will say, okay, 3.5% is great, but let's not lose too much sleep over if we miss this 3.5% target. Let's focus on employment generation. Let's focus on consumption. Let's focus on the capex cycle. The RBI is likely to keep rates low unless we see a shock on the interest rates front, on the inflation front, right? So that's the broad contour of what we are likely to see here. Fiscal deficit should rise in the near term. That's generally a negative trend for equity markets, but I think markets would probably take it in the stride purely because there is a motive there, and if there is a country who can target this, it's likely to be India, because even if India borrows locally, right? So we don't borrow dollar loans, we borrow rupee loans. Government of India borrows from you and me. And how do they borrow from you and me? When we put money in the bank is supposed to put out something called as SLR, which is statutory liquidity ratio, which buys those government bonds. So technically, you and I go ahead and fund some part of the Government of India borrowing at this point of time. Currency will have two issues, which is what do we do with foreign flows and what do we do with net exports. Now, foreign flows long term should be fine, right? No problem there, purely because there are limited avenues for foreign investors any which ways. And in a large maturing geography or economy, India is one of the top destinations, if not today, then at least for the next few years. And this mandate ensures that certainty in decision making, which generally foreign investors like, is going to be useful for us, right? So that long term is fine. Short term is a question mark because lots of things are happening in the short run, right? If there is trade barriers that are being put in, if there is going to be a global slowdown, there could be a global ruckus that gets created because of that, then there could be a short term foreign outflow possibility that can happen. Also, the challenge that in the short term comes in is what happens to our currency, courtesy what happens to oil. So, that's a complicated scenario. If oil prices go up, then on this currency page, if we look at this, our import bill goes up. If import bill goes up, the self-correcting mechanism is currency will depreciate. If currency depreciates, right? If the dollar appreciates and rupee depreciates, INR depreciates, then what happens? Basically, that's like saying we are at 70 today, we are going to 80, right? I'm just using a stark example to explain this. But let's say at 70, someone puts $100 in India. So that's 7,000 rupees. And they invest it into some fund, which takes it down to 8,000, right? Now that's a return of what? Approximately about 14%. Right? That's the return that you made on this. But when you sell it and you convert it to dollars, you divide by 80 if the currency has depreciated, you get $100. So while you actually made 14% return on that instrument in India, your net return was zero because the currency ate everything. FIs don't like falling currencies, right? So as currencies fall, if we are unable to kind of take care of our export scenario, then basically that's a risk that we run, and that could then create a short-term outflow or panic that can happen around that. So you have to be careful with that scenario. In terms of our import-export scenario, what I have been a long believer of is that anything that increases exports will see a push. So things like textiles, where we have lagged a lot over a long period of time, is likely to see a good push. Things like tourism, inbound tourism, right? People coming to India, that's basically kind of an export because you get dollars in. That's going to see a sort of a bullish phase from the Government of India. On the imports front, you would try and do things that reduce imports. So you would want electronics manufacturing to happen in India, right? That policy making should be benign. In fact, you would want also to look at some sort of an auto ancillary export happening out of India because that's reasonably strong in India. But that again is kind of stuck with global auto slowdown as we speak. But we would want to kind of focus on some of the low hanging fruits to increase exports right away. As we speak, there is a policy that is trying to double India's exports by 2025, but wanting doesn't get it. We'll have to see how this plays out. If this plays out well, this is extremely positive for the currency. If oil goes down, that is extremely positive for the currency. Uh, but we'll have to see and watch what happens here, right? So net impact in terms of what I see, at least on rates and other areas, is you are probably going to see lower interest rates, right? Lower over medium to longer term, right? Currency is a difficult beast to predict, but I would suspect that in the short run, it would depend on flows, and in the long run, it would depend on the export scenario that we tackle. In the absence of this support, it is likely to see an outflow of money from India, and that will mean a weaker currency regime in general, right? So keep that in mind, that to kind of help our currency appreciate, we require a little bit of a boost in terms of our growth, and we'll have to see how the government funds that, because the government will have to fund this higher growth via their own spending and lower interest rates. So these two are probably going to happen. So we are going to also see higher fiscal deficit in the short run, and that could again kind of have its own set of interesting outcomes. Although I don't think this is such a big problem for India. We should increase investment in sectors such as infra and roads and power, and make a big infra push in the next 4 or 5 years, because that's what is going to create sustainable jobs as we go along, right? So that's likely to happen because now they have all the mandate and there's no real reason. So you would probably see a lot of the tougher decisions happening in the first couple of years as well. So let's see what we do there in terms of that. Equity markets will react based on a combination of the macro and their own valuation scenarios, right? Now, combination of macro we have seen, typically lower interest rates are positive, depreciating currencies slightly negative, uh, you know higher fiscal deficit in the short run is slightly negative, but investment in infra and this thing is positive. So we'll see how that plays out. On balance, this event seems a positive event for the equity markets, because equity markets don't like uncertainty, and as soon as the uncertainty goes out, equity markets are happier with that scenario. Having said that, the own valuation segment itself is a concern. So let's look at two charts. This one has been picked up from a website called Nifty PE ratio. Picks up the Nifty PE ratio and the historical. So whatever are the numbers, price to earnings ratio that we look at. So this earnings is what is the last 12 months earnings, right? That is available. Now, red or deeper red means overvalued and dark green means undervalued. And you will note that the darkest shade of red are available somewhere here where we are today. And this is from 1999 all the way to today. Now, this could be looked at both ways, which is, there are only 3 points where this has become really red. There is one here, there is one in 2008, and there is the one this is here. So we should be careful. Having said that, this period has now lasted a good nearly 1.5 to 2 years of dark red valuation, and that's never happened in the past. So maybe there is an expectation of a revival with the markets, right? Expectation of revival. But do keep in mind that that you need to be careful looking at the valuations of Indian markets at this point of time, because some of them are pricing in a substantial rebound in growth, and any negative that we see on these parameters that we see here is going to have a detrimental impact, right? And then it spirals. If currency falls, then FII pulls out. If FII pulls out, they sell equities, which result in equity markets going down, which means currency falls further, which means more FIIs pull out. So it kind of becomes a cycle if it starts. So we have to be careful with that. And I think on the economic front, we should revive post this initial bout of slowdown that we are seeing. But on the markets front, valuations are interesting. Now there's another chart we have, which is basically a ratio of the BSE Sensex to mid cap, right? So Sensex is India's large cap index, and mid cap is India's mid cap index. So we are looking at large companies versus mid-sized companies. If this number goes up, that means large companies have done better than the smaller companies or have become overvalued relative to smaller companies, right? So if the number goes here, you should buy smaller companies. And if the number goes low, you should buy larger companies, right? Now, somewhere in the end of November 2007, November 2017, beginning of 2018 is where this entire carnage in the mid cap stock started in India, and there was a very clear signal around it that you should have basically at this point of time mid caps had substantially done better than large caps, right? Just to give you an idea, uh, if you're looking at a ratio of 3.5, if this is 350 and this is 100, that ratio fell to 2, which means 350 probably stayed 350, 100 became 175, right? The actual numbers were this gave about a 60% return and this gave about a 200% return over this period. So then you obviously saw that problem. Now, already, if you read some of the text, they are saying that mid caps, mid cap companies are undervalued relative to large caps. Relative to large caps. Obviously, they are because they've fallen more, but that is a so that's one way of saying is that if something is at 100 and the other thing is supposed to be 100 but it is at 50, right? So if large cap is 100 and mid cap should be 100, mid cap is at 50, that's a mid cap undervalued relative to large cap. More likely what's happening right now is both should be at 100 and this one is at 150, right? So it's still relatively undervalued when compared to the large cap, but that's not necessarily why you should invest. In fact, over the last couple of days or so, you would read a lot of commentary that is saying buy mid cap stocks in India. Uh, we could be wrong, but it might be a tricky game with the equity markets in the near term because some sections are completely overvalued, and this mid cap buying thing becomes a very good reality only and only when there is a sort of a reasonable long drawn correction. Like for example, the last time this ratio was here, it went back to the average and then came back down once again before it started kind of going up again at some point of time, right? So keep in mind that we've gone back to the average. It's quite possible that it comes back down before it starts going back up. So there's just a very simple toolkit to understand where relative valuations are, but it seems like the markets are overvalued or at least richly valued, even if we don't want to call this overvalued. That's something we need to kind of be careful about in terms of the equity market scenario. That is in a nutshell what probably is our expectation on various markets at this point of time with respect to this particular government that has come in. That's broadly what we wanted to discuss today.